All right, so good morning, Professor Douady. Thank you for accepting our invitation for this interview. And just to make an intro about you, you are a very well-known economist and a mathematician, and you have an expertise on chaos theory and quantitative finance. So we also know that you have a very large experience in financial instabilities and nonlinearities and systemic risk, and we'd like to approach a more informal conversation today about your expertise and your work applied in real life.
You know Felicia directly, but I know you indirectly because I'm familiar with Nassim Taleb's work as well as your book on financial markets and AI, which you co-authored, and also other areas of your work. And we're trying to explore different relevant topics for our audience. And our audience mainly consists of business people, venture capitalists, business angels, and startup founders. So I think it's a good idea to just to use the specific language that is, I mean, not to get too mathematical and
No, but this is it's a crowd who is very exposed because they need to understand both the economics, the general economics of investing in companies, and the specifics of why such or such technology developed by such or such company has a chance to make a breakthrough, etc. So they need a double expertise of the economics in general, the investment, and the expertise of the technical thing of each company. And even though very often they call experts to analyze a project, if they don't understand themselves, I mean, someone becomes an investor in biotech, he has no clue of biology, he will be a very poor investor.
Yeah, that's what usually happens.
Unfortunately, but that's where, I mean, precisely, I mean, I think the goal of this interview is to shed the light on both aspects.
Yeah.
We just want to attract more people into this field.
To point out that we don't have any risk managers, we don't have risk takers. So that's a good thing.
I mean, same thing. I mean, a risk manager who is not a risk taker hasn't understood risk management.
Yeah. What are you working on right now at this point?
Well, I'm working on a project that I'm trying to develop, which is use this technology I have developed in RiskData, which I call polymodels, and it's a new project. I mean, it's a project I've been working on for many years because it was the core offer of RiskData for people who invest in hedge funds. But I want to take it in a different mode. Instead of a software, I want to do a service on a website where all institutional investors could get some understanding on where they're invested, especially in the world of hedge funds, which is very complex due to the development of robo-advising and AI, etc. The strategies of the hedge fund change a lot. The categorization is completely different, and investors who are facing that world, they don't know exactly where they go. They're very often stuck with this joke that you never get fired for having hired the IBM. So they put their money in the very large hedge fund because say, okay, well, at least whatever happens, everybody does that, so I won't get fired. Because you have to realize that the institutional investors who invest in the hedge funds, they are, I wouldn't call them civil servants, but in somehow they are working in large institutions, they are exposed. Yeah. So it's more important for them to make sure that they don't do mistakes. And so if you then invest in Bridgewater or whatever, okay, well, whatever Bridgewater does, that's okay. But if they invest in a small hedge fund, and that small hedge fund is shaking, they will be reproached having not checked sufficiently what that. So I'm trying to propose a system that will give as reliable as possible an analysis of every single fund so that people know where they are, what they do, etc.
No, there's pretty much the same problems in venture capital industry.
And eventually, I want to address that. I mean, next are 3 areas which are of concern to investors. Not talking of liquid markets, is of course venture capital, private equity, and real estate. They are the 3. And of course, I mean, then other kinds of alternatives, but basically those 3 drag a huge amount of the investment. And they each of them get their own specificity, their own categorization. So that's where, a different kind of statistics, something that is more insightful, that follows precisely, you were talking about nonlinearities. That's where you get more insight in what you're doing.
But can you actually model the let's say the investments in venture capital, because you don't have any past data? So
it's not a matter of past data. If I am an insurer and a young kid just got his driving license and says, look, my insurance should be very cheap because I never had an accident. Of course, you just had your driving license, but I have a good statistics of young drivers, and actually they have more accidents than older drivers. So you see, when you invest in venture capital, the problem is not that particular investment that you're doing, is categorizing the investments and making some statistics of what is that investment, what variables it depends on, and so that you get the risk of that investment. There is dozens of thousands of companies which are raise capital every day. I mean, it's so that makes a lot of actually the statistical basis is very broad.
But I think you mostly refer to, let's say, Series A, Series B, and later stage companies, right? Because in very early stage.
Exactly. That's what people are led to. You see, they stay away from seeding, where seeding is very often where you get the biggest growth, but also you get a failure rate which is enormous. So if you can get, something that's a bit less, some insight that puts you in a better odds than purely blindly investing in everything, that which variables matter, so that you should focus on that. And at the seed level, you see the economic impact can be very strong.
Usually the best seed level investors are the ones who have the most robust heuristics. They don't actually.
That. Of course, people rely on heuristics, but beyond heuristics, that was one of your questions actually. Beyond heuristics, at some point you want to systematize it and again go from heuristics to metrics.
So how do you actually do that? How do you systematize?
One of the key things when you have a complex system that depends on many variables is before trying to get a model of fitting with respect to variables, is determining which variables matter. So you get something that may depend on 1,000 variables. I'm not talking of something that depends on 5 or 10 variables. Precisely, you want to go from 1,000 to the 5 or 10 that have an impact on what you're doing, those that you have to measure. And those variables won't be the same for everyone. And that's where, so people go to, as you say, heuristics. I have an investment of this kind in this industry, so I will look at this and this and this. In the fintech or in the med tech, for sure, regulation plays a huge role. If you go to technology, it will be the technology they are using, etc., and the race. And the comparison with strongly funded projects driven by Google or others. So you see, you could go for something which is an analysis as there, but in fact, if you do purely statistical work on precisely, you find some variables that you didn't think of. And that's where you want that's where you want to do the thing, you see. So you will take, hundreds of different projects and look at, variables that are specific to each industry, variables that are common to it, the age of founders or whatever, and you will try to see for a cohort of cases for which you have 10 years history of the future, what they looked like at the beginning, and which, those who went through. And, the joke I'm having, is this young investor, entrepreneur who comes and says, but, I drink the same coffee as Warren Buffett. I intervene on the same social network as Elon Musk, etc. How come I am not successful?
Right. So you're using the same approach as you would use with let's say classical financial assets, pretty much.
I will tell you how I do with classical financial asset, and it's not a classical method.
Okay. The reason I ask you that is because as far as we know, most investors they more often than not rely on heuristics rather than data.
Yeah,
So,
absolutely.
sometimes you get some very weird heuristics, like having even the founders from the same school as the investor. It's a good sign.
There is the classical heuristics, for instance, in venture, which is the free cash flow.
Yeah.
And people say, you have to watch the free. Of course, you have to watch it. And I'm sure that I'm doing a statistics. Basically, if I'm doing a thorough statistics and free cash flow does not come up as one of the meaningful variable, probably I made a mistake.
Right.
It's always the same thing. I mean, if you have an automatic system that contradicts a very common practice, then you should question your system rather than the practice. But the good thing is that, if it comes up with that, but says on top of that, here are the things that you should take care of, that's what you expect from it.
But even if you use the data, still, even after the initial public offerings and even after late stage in the, let's say, series, there's still a very weird distribution. So even
Yes.
after series A and B, most startups still fail.
Yeah, of course. I mean, sometimes you get some unicorns, and unicorns appear, not at Series A. I mean, it's Series A. You still don't know what will be. You can see it will be successful, but you don't know which level it will be successful. And those ones who are really becoming unicorns, you see it late in the story. Right. I followed, for instance, the one of the very early investors. Two of the very early investors are in a lending club, close friends of mine. It took them, I don't know, 10 years to see that lending club would become a unicorn.
Yeah.
And I followed it very closely. Same thing for the Bitcoin. I mean, when it started in 2011, a very close friend of mine, Ricardo, Ricardo Perez Marco, was a mathematician. We were doing math together. And he, Raphael, you should buy. I was so busy with my company, RiskData, that I didn't, follow his recommendation. I could have put, $100 in it. I mean, euros, whatever. I just, forgot because I was busy with other stuff. And you see, you get the information, but it's also processing it, taking it, whether it's risk or whether it's profits.
Yeah. No, we actually talked to Gerd Gingerenzer several months ago, and he confided to us that in his area of work in academia, after the large language models launched on the market, they're already widely used. So both by professors and by students. Do you see? I mean, machine learning and AI was prevalent in finance long before ChatGPT appeared. Do you see any changes? Do you see any use cases of large language models in finance at this moment?
Of course. I mean, there is something very goes across the board, but it's not always, where you expect it.
Yeah.
That is LLMs. People want to get in. Okay, there is a tendency which I have is people want AI to replace humans, not so much because, I mean, the facade is it will give me some information that humans cannot process. They will see things, etc. The reality is different. The main thing that AI is bringing is deresponsibilization. That people say it's a computer who decided, it's not me. So if there is a mistake, I mean, the fact is that AI will not, I mean, AI will not, is in reality more or less as clever as a human, not because it is very clever, that's because humans are a bit stupid. I mean, they can be, you see, there is a gap between, oh, I see a situation, I'm clever, I'm making a very good analysis, and the actual decisions that are being made. So if you look at the understanding that people can have, can be very clever, and in the end they make decisions which are based on very simple heuristics which any AI can reach as a quality. So it's not because people are clever that they make clever decisions.
Yeah. But does AI introduce new dimensions to moral hazard, as you said? Because you can just say, well, that's what the machine said.
Human people have an enormous moral hazard. I mean, it was it's like look at the self-driving cars, and people say, yeah, what happens? The least accident provoked by a self-driving car will make the headlines. So you get a problem, etc. But look at how many accidents humans have. And I'm not sure that self-driving cars are more killing or less killing. I mean, there are not enough of them to tell.
Yeah.
But I'm not sure they have more accidents than humans.
It's also scale dependent. I mean, it's a little bit
the only thing, yeah, exactly. People always think that if I take the wheel, same thing. I mean, okay, you need to go to on the East Coast, you need to West Coast, or you're on you're in Italy, and I'm in Paris. I want to go to Italy. I have two possibilities. I take my car, or take the plane. So three possibilities. I take the train. Okay, two of the possibilities, I have absolutely no control on it. There is some risk. I accept that risk, and my car, I'm in control. However, the odds are, I don't know, 100 times more than even planes which are themselves about 10 times the train. So it shows you that what we are ready to accept as a risk, if we think we are in control, is simply because we think we're in control. The reality, what do we control? We can even assume that we are a very good driver and we never, that we don't sleep, we don't, etc. We are in full control and maximum capacity, which is not always the case. But assume that we are at that. There's something we don't control, are others.
The other players in the field.
Exactly. Whereas the whole system of planes and trains is much safer as a whole.
Yeah.
So of course there are regulations for the car traffic is regulated, has traffic lights, etc., speed limitations, but still, I mean, not everybody respects it. Much less than actually planes respect air traffic control. So you have a lot of, I mean, there is no zero risk, but the risk of something that you imagine are in control of, in fact, is much bigger than the risk of something that for which you have zero control.
Yeah, if we actually have this parallel with the airplane traffic and trains, maybe at some point, if car traffic is as regulated as the airplane traffic, so there's not much variability. And let's say 99% of cars are self-driving cars. Maybe we'll have a different level.
Yeah, exactly.
There's one thing when you have 10% and
self-driving cars, and then when all the cars are
self-driving.
Exactly. So you see, I mean, the question of the moral hazard of AI Of course, there is a risk also that, okay, I come from dynamical systems.
Yeah.
Now take a very complex system made of all computers, just like you just said, all the cars are self-driving cars, etc. Same thing, suppose all the traders are automatic traders that respond to just simply, are computerized through neural network, etc. Is it more risky or less risky than humans? What do you think?
No idea, actually.
For me, the most likely, I'm not saying I have zero theorem. I'm not saying it's I'm just saying it's very likely to be the same.
Okay.
And the reason is very simple. Humans also respond to stimuli, and in fact, we are robots in some way. As I was saying, even though we can think after the fact and have very thorough thinking, when we're on the spot, we make decisions with very poor information.
Yeah.
So not very cleverly.
Or maybe we're blinded by some heuristic or bias.
And we are like that. So if you look at the statistics of the stochasticity of financial markets, the stochasticity of car traffic, of air traffic, etc. Of course, it is bound by regulation because people have to do something, which is the same whether it's humans or computers. And the rest is I call it some thermodynamic equilibrium. People, follow each other. That's where we see Pareto distributions, because if people were completely independent of each other, then the central limit theorem would apply, and all the distribution would be thin-tailed. Like a Gaussian, etc. But since people influence each other, like in turbulence flow, in fluid dynamics, etc., since they influence each other, you get those small bubbles that pop up permanently. And so with a certain probability of a certain size and the distribution of probability versus size, which is exactly Pareto. And that's why we see those Pareto distributions appearing in markets. Do you think that computers will be different? It's as complex a system. So the equilibrium will be, it will be through the organization of these very complex dynamics. It will, there will be a very, complex attractor, but with the same type of distribution.
Yeah.
There is no reason it should be different from humans.
Yeah, machines also influence each other because
exactly
one model's output is another one's input, especially the change of the data on the internet.
Exactly. And so you see the same thing. Yeah. And because what we see is eventually through evolution, the convergence of the ergodic distribution of a very complex system, there is no reason why if the cells of this big complex system are computers instead of humans, in the end you end with something different. It's very likely you get exactly the same thing. No, going details, yes, you will see something different. If you look with a microscope, the behavior of every single that will be different. Maybe instead of Warren Buffett, you will get, some deep blue who is particularly clever compared to other computers, possibly. But the whole market as a whole will be similar.
Do you think the whole system will be as fragile as currently, or more fragile, less fragile?
Would we still see crashes as we see them today, or?
You said during the Rory Felicia Robert Fry's talk, where he showed that the apparent, the 29 crisis, the opening of the Fed and the regulation, the Bretton Woods agreement, and then the end of Bretton Woods agreement, all of that barely changed the statistics of extreme events. So now I come to another point which I wanted to say when I was talking about identifying your first question about identifying the variables. So a good system, the first step in good statistics, because we know that we depend on many, many variables, is identifying which variables. So, you know, in machine learning, you get those Shapley indices that, you know, that give you, you know, the sensitivity of the output to certain variables and tells you, okay, this variable matters more than that, etc. I think something which is very important is that those variables who really matter are not only those that have a particular sensitivity like a beta, but those who also induce some threshold effect. So you get almost no sensitivity for small moves, but there is a point beyond which it has, and those variables are those who in a good system must be included in the model, because if you don't include them in the model, then you will miss the point, because you will your model will say, okay, well, you know, it's suppose, yeah, you jump and because we have some resistance, we are able to jump at different size, at different heights, and basically the outcome doesn't depend. I mean, if we jump between 10 centimeters and a meter, even a meter and a half, what we get out is almost the same.
Yeah, in this range.
But there is a point in which we are going to break our legs, or we are even going to die. So you see, there is a threshold effect, and the variables. So you see, it's like, you know, elasticity. You get a system that has some elasticity. So if you pull on it, the elastic will bring it back to the. But at some point, if you pull too much, you break the elastic and it doesn't come back. Those threshold effects are variables that it is very important to include in your model. That's a lot of the hidden risk of this nature.
Right.
They are ignored because they don't have a direct effect. They only have an effect. I'm sorry. When they only have an effect if you move beyond a certain point.
Right.
So when the stressor is too high, but you'd only know about it when you come to the threshold.
Yeah.
Exactly.
Right.
So it's only when you exceed that threshold that this variable comes into the picture. If you haven't put it in your model, you get a faulty model, because you get this illusion that this variable doesn't matter. In other words, you see that when you test whether a variable matters, what is important is not just the first derivative, not even the second derivative. It's the impact of stresses that correspond to the tail effect of those variables. That's also why it is important to measure the tail distribution of every single variable you are working with.
That's an interesting insight. I'm trying to think of some hidden variables you could include into a model assessing venture capital investments, and I can't really think of any.
Oh, there's lots of them. There's lots of them. The first that comes to mind is suppose you invest in something and you say, well, at first it doesn't depend much on capital markets. I mean, I have the funding, etc. And then suddenly there is a crisis, a big crisis, money dries up, and then you realize that this company, actually its outcome does depend on the move of the S&P or the move of the, but not in the primary sense, because you've hedged everything.
Right.
You've secured capital, etc. But at some point, if the shaking of the market is too big, even, you know, I can tell you, a story of RiskData of my company in 2008.
Sure.
And you will see completely paradoxical effects. The company became famous at servicing all the fund of hedge funds.
Yeah.
It was at some point the biggest risk system. It was a system that was the most used by fund of hedge fund, even ahead of the giant risk metrics. For that particular sector, altogether, the assets that were risk managed by our system was above $1 trillion for a total investment in hedge fund, which was about 3 trillion. So it's like, a third of the whole investment in hedge fund. People were looking at it with the RiskData system. That's the commercial success. That was before the crisis. When the crisis approached, we literally received, it was in the first half of 2008, in the spring, May, June, we started receiving phone calls from our clients saying, we are using all the system. We are using RiskData, we are using RiskMetrics, we are using Barrau. Usually the three systems are in the ballpark for all the funds we're invested in. It's comparable. Here we have a problem because half of the funds in which we're invested, your system is giving figures that are 3 times those risk metrics. And how come? And we told them, well, we don't have the same statistical approach. We don't do things the same way. We are looking at the sensitivity, nonlinear sensitivity to risk factors, and we include some nonlinearities just speaking about. And we checked, give us your data. We will tell you which risk factor pops up in the system and is responsible for these figures. You do whatever you want, you believe whatever you want, but at least we tell you what we do. We open the box. It's not a black box. You can see exactly what's happening and why we make this calculation. Okay, thank you very much, etc. We were feeling the crisis was coming, but we don't have a crystal ball. I mean, then the crisis occurs, and we see that our system was seeing those funds who would resist the crisis and funds who would blow up, like in black and white.
Oh, really?
It was amazing. It was like, the biggest proof that that should work. Then, in order to do some marketing of the quality of our system, we call our clients and ask them, okay, how much money did you save thanks to it? Oh, we would have saved a lot, but it was so big that we couldn't believe it.
So that's an impressive result.
So that's first thing. Second thing that happened that was much more terrible for us was at that time, we were using fax machine, etc. It was not even email. I mean, there was an email, but the fax machine was working every day. We get 3, 4, 5 cancellations. I mean, when you are managing a company like this, you get people to pay at the end of the month, and you see those cancellations coming one after the other. So of course we call people. So what's your problem? You were dissatisfied with? No, but we're in cost cutting. We have to save, and yeah, even if it's clever, we don't have money for clever thing. We just have to answer regulation, and that's it.
They didn't realize the impact.
No, it's worse than that. You see, suppose that you have a very sophisticated, you are a medical doctor, and you get this very sophisticated PET scan, MRI machine, etc. And even because you have this machine that costs you a lot, because you have to rent it and pay the rent of the machine all the time, even if even if you have this machine, in fact, you're a good doctor, you could see the thing, and for XYZ reason that you cannot explain, you didn't believe what was there, and you didn't save your patient, even though you got the information from the machine. And then suddenly you have to to cascade. Then you say, well, okay, maybe that machine is very clever, but I'm not using it. So that's the first thing I'm going to discard.
Yeah.
So it's like seeing a tumor in the patient and you don't believe the machine, and then the patient dies and you ask yourself, oh, why did that happen?
Exactly. And in the end, you say, okay, the machine finally didn't help me.
Wow.
Even though it was right, even though, etc. We even got another story. One of the clients was a fund of fund of Santander, the Spanish bank, and they were heavily invested in Madoff. And they call us, you're making us with legal problems, so we have to cancel our subscription. Say, how are you making us legal problems, and why do you sue? You are dissatisfied, etc. Now you understand. It's already 6 months that your system is telling us that there is a fraud risk, and we didn't react. And now the regulator is asking us why we didn't react.
So it's very counterintuitive.
No, it's
So
actually,
you see, the real case of risk, that's why, I'm telling you, you can be clever and still make stupid decisions. At some point, the thing that will take you out of your comfort zone, that you will make you, change your attitude and really take into account what your system. I mean, you see that a system, even a clever system, is inserted within a process. And if your process doesn't have room for that system, the system will be ignored. And that's where that's where it fails. It's not only the fact the system is more clever or less clever, it's also that you have to insert the system within your process and make that system an unavoidable step in your process. And that's a human responsibility, that's an organizational responsibility. So basically, you're proposing me an investment. I want to see what the system is saying. Yeah. And if you don't take that into account, then it's a no-go.
Do you think that the bailouts play a role in the survivorship rates of those clever guys that make stupid decisions?
Of course. I mean, the famous skin in the game. I mean, if people, that goes back to that question, I'm not getting fired for having hired the IBM. I can afford to be stupid. And that's a paradox, because my role is not to educate people in reality. It's to build machines that will help people. I mean, of course, I try to educate people as well. But what I do for a living is more, building machines that will help people. And believe me, I have a very close relationship with the funds or the family offices that I advise. And the time we spend analyzing the actual decision versus what the math are doing is enormous. You see, people are seeing the result of the statistics, and between that and what we do actually, that's where a lot of time is spent. And you see, it's this step is really not obvious.
Yeah.
No, I have a number of war stories like that. You see, and that's where, I mean, if people, the cost of failure has an enormous impact on the decision of people.
I think that in the startup world, there's a better situation because we don't really have any bailouts, at least for founders. They mostly have bailouts for some big institutional investors. Yeah, so maybe there's less stupidity in decision making because people simply don't survive long enough to.
I'm not so sure.
A limited runway of months.
It's not so sure. They have heuristics. For instance, I can tell you the story that led from the tech bubble in 2000 to the financial crisis in 2008. They're extremely linked. In fact, it's not one is a consequence of the other. And what happened in 2000? I mean, in '99 there was a craziness in markets, very comparable to the craziness that we have these days on AI, etc. It was internet, everything that was called .com. There were jokes, you know, even, you know, you could take the name of your dog, .com, and raise money out of it, etc.
At this point, actually, there's a similar situation, but not many investors are falling for it. I mean, the really good ones are.
They are, okay, there is something which is
ones that
interesting.
survive all the crises.
That is something which is interesting. You see, why do you have a Silicon Valley in the US and not in Europe? And if you look at VCs in the US, in average, the NASDAQ fell about 75%. And that was the average loss of VCs in the US. The average loss in Europe was 95%. The difference is enormous, because 95 means that you have to regain from a 20th of your investment. But the other one is the power of your investment changes a lot.
Why is that?
Precisely because Europeans not being familiar and having, like, you know, a very comfortable system, etc. They were playing stupidly, you know, like, you know, I take everything that comes to me and I put money, or same amount of money, and whatever works. So they were playing pure statistics.
Yeah.
The US, they have a whole ecosystem between seeders who are actually angel investors. An angel investor is something very specific.
Yes.
It's someone, because, you know, I created several companies, we're talking to them. There are people who call you, they are next to you. Oh, you should meet that guy, etc. They help you develop the business. They give you advice, that won't work, etc. They are at that stage where you can have someone who is clever in terms of, you know, building a system, etc., and has a bit less of market, and you just need, you know, sometimes it's a matter of networking to get the clients, etc. To convince, even if I could take my phone, I meet the person, the client, etc., and I speak to the client, and then some friends who is himself an investor close to the client will tell him exactly the same word I'm saying, but he will be believed.
Yeah. There's this credibility thing. Yeah. Also,
Exactly.
angels are playing they're gambling with their own money. So
they have their own skin in the game.
It's also, you know, when, you know, where you're talking with people who are both successful, they're speaking, there's some understanding, and it's not taking the same way. Okay, that's that young investor that young entrepreneur who is building a system. Of course, he's going to pitch me. And now you get your friends, you know, maybe he's pitching you, but the guy is really good, and what he's doing, you should take it. Okay, let me have a second look. You see how it works.
Yeah.
And so what happened during, you know, from 2000 to 2008, in fact, and that's what we are seeing today, you know, with the same, you know, rush towards AI, people were investing like crazy. And you have no clue of the kind of question I was asked at that time. I was working with the bank, but I was already doing my consulting. And, you know, there was some logics like, you know, modeling a venture investment. You get a call option because there is always, you know, they can go up but not down, because you can always close the business. So it's model with there is you know, lots of models, what is called data mature models like that, you know, that models for call option, etc. And so because it's a call option, the price is proportional to the volatility. And because the volatility, there is huge uncertainty, the volatility is very high. So the price of the project should be very high.
Yeah, the premium.
And then you look at it, they say, yeah, here's the logic. Did you look at the strike? I mean, what is you are still in probabilistic estimation? Yes, of course, there is a certain probability that you will make 1 billion, but let's see what the probability of that thing. And to get that probability, there are certain steps, and you have to estimate the step of each step. No, but I want to have a Black-Scholes type of models. You know, Black-Scholes work because you assume that you are hedging the options. Are you going to hedge that investment? There is no way you can hedge, so it doesn't apply. But still, people were having, you know, some you saw, you know, some papers saying, justifying basically the speculative bubble.
Black-Scholes sometimes works because that's what they learn in business school. So
no, exactly. So it's just taking something, and provided you can sell it to some guys who use anything.
Too bad there's no alternative too bad there's not a way to hedge against the downside in the venture capital markets.
Yeah. So anyway, so that created the bubble. Then the bubble broke, and there was this heuristics that venture capital should deliver 15%. I mean, how can you deliver 15%? The reality that they were delivering 5 to 7%, something like that. But they had to show 15%. It was a magic number. And of course they did not. So they were artificially, when the bubble crashed, what did they do? They had all those investments they were in, you know, there's some they had to write off. And some they took, you know, those who were making money, the good guys, and they made what we call leverage buyout, in order to get some cash and to show some cash to their investors. Now, if you put a leverage buyout on a healthy project, that's the best way to make the project fail, because you expose it to this Minsky instability. You borrow when you don't need to borrow, and on top of that, the money you have borrowed, you don't invest it. You give it as dividends to the shareholders. So you have put a totally useless debt burden on a company that otherwise would be very, very efficient.
Yeah.
The consequence is that the debt, the leverage of the debt, the average leverage of the company between 2001, I mean basically 9/11, until 2007, you could see the leverage go up to the point where the whole system became unstable. And that was, you know, what created. So it was first a real estate bubble in 2007, but that real estate bubble, when it blew up,
just spilled over other asset classes.
Exactly, it was like, you know, the detonator for the whole thing.
Yeah.
And actually, personally, I was thinking that it would blow up in the spring, and I was even surprised that it went all the way to the fall. So you see that if you're asking, you know, what's happening in EA, does that mean that all the projects? I mean, who could have told, especially with all the stories of Steve Jobs in and out of Apple, etc. Who could have told that today? Today the biggest companies are still Microsoft.
Yeah.
Google was important already, but still was a small company. I remember people say, "Don't you think that Google is expensive?" I don't know. You know, I was unable to tell. But it's like, you know, it went a factor 20 between what it was in 2001 and what it is today. So who could have told that, you know, Alcatel-Lucent would go down? That, on the contrary, the Amazon was almost inexisting, etc. Tesla did not exist. Musk was one of these managers of PayPal, and people didn't know about those guys.
Yeah.
So if you want to know who will be the successful companies in 10 years in AI, as of today, yeah, there is, you see, there is another parameter in venture capital that nobody says, and that I don't think any statistical system can analyze. And I'm not even sure. Probably, if we get the right data, there would be some possibility to analyze. It's not the funding who is there. It's the wealth of the family of the founder. If daddy is rich, the company has a much better success rate than his daddy is poor. Or money.
But if the dad is
And that's
rich,
very unfair.
influential, that's
I fully agree that it's totally unfair. And some people have the chat, to convince investors and get, and yet there is a correlation here that those whose parents are rich have a better chance to get, these chats to convince investors.
I think that you could get reliable data in the US because you could just take the zip codes of the founder's family and.
I think you can reach the data in any country. I mean, I'm talking developed markets, but and even not only. I'm sure you can get the data on the wealth of the family of the kid, where the kid is coming from.
It also can act the opposite way.
Of course, it can act the opposite way, and there is a. So anyway, but you see those kind of unexpected variables. But when you think of it, and where does that matter? If your project works as on paper, nominal data, finally you do your stuff and you develop, etc. Fine. But if it doesn't work, and everybody, investors, what do you get from a family who is rich? Legal advice, money, the fact that you can, always, okay, well, you get unconditional support, a bit like you were, exactly, a bit like plus a network, etc.
Yeah.
Get your first clients, and then the next ones, and so on.
Exactly. And I agree, it's totally unfair. But if you look at it, look at Bill Gates, who was his parents.
And also, you always have the chance to go back, so you're willing to take more risks than the average, let's say, founder.
Yeah.
Yeah.
So now, if you ask me, a good system should capture that. If you have the information,
yeah,
then a good system should capture what is those. There is no reason you should do something else. Now,
and also the opposite maybe. This parallel Nassim Taleb does with the butcher, with the doctor, the surgeon who looked like a butcher.
So that's another.